So stocks today, as you saw, a little change after Alcoa posted lower than estimated sales, and UBS advised investors to sell regional bank shares. Fritz Meyer is a senior market strategist at Invesco Aim, which has $154 billion in assets. He joins us now from Denver to discuss why he's still optimistic about recovery and profits. Welcome to you, Fritz. There's always a lot of concern, right, as the initial start of earnings underway. We've seen sell-off last couple of quarters here. So what are you anticipating in terms of how earnings this time around will impact market direction?
Well, it could be that a lot of the upside surprise expected has been discounted in stocks, and maybe stocks take a breather. But, Laurie, here's the important part of the big picture, in my opinion. The earnings estimate on the S&P 500 continues to creep higher towards $100 a share for next year. And why that's so important is because I think the fundamental trajectory of the stock market suggests that over the next couple of years, stock prices are going to regain the old high of north of 1,500 on the S&P 500. In other words, there's substantial room yet to recover in stock prices, and that's why I think particularly the economy-sensitive sectors of the market, and financials in particular, which have the most to recover to their pre-crisis levels, offer significant opportunity. And I'm not saying it happens this quarter, and I'm not saying it happens in a straight line, but I think over the next couple of years, investors will be amply rewarded in stocks generally, and particularly in the most economy-sensitive sectors of the market.
All right, so
financials, industrials, materials. Yeah.
I was just going to throw in a question, a quick one about risks. What concerns you? What could curb market gains back to the highs?
I think the big risk, in other words, and the risk that could provide volatility, not necessarily change the underlying trend, but I guess what I'd be most concerned about is if bond yields start to lurch higher. In other words, not a smooth, steady trend, but let's assume we wake up one morning and the 10-year Treasury yield has gone from a 3.80 to a 4.25. Let's say that happens in a fairly short period of time. That could spook investors, but history suggests that actually that wouldn't be a bad thing for stocks. It's not a reason to sell stocks. In the short term, we could see a knee-jerk reaction in the stock market, but actually rising interest rates have been fully consistent with each of the last bull markets, and so it wouldn't shake me out of the stock market.
All right, so you did mention you like financials. I'm curious, though, we've still got so many underlying concerns stemming from the crisis. We're reporting on Washington Mutual, on Citi, with these liquidity swaps at issue now. I mean, is any of that a concern to you, as could curb the gains we've seen in financials of late?
Well, I think what you put your finger on a very important point. In other words, when the crowd becomes fully complacent, that's a real time to really worry. But in my view, because there is still so much doubt about the sustainability of this economic recovery, in other words, over the last couple of weeks, I think there has been capitulation with respect to strong first-half GDP growth in this country. But I think the investors still are very concerned about, well, what happens beyond that? And I think that is precisely what offers upside potential over the next couple of years, if you do believe the sustained economic recovery story, which I clearly do. I think the evidence, if you look at the leading economic indicators, the global leading economic indicators, the PMIs, these are very strong forward-looking economic indicators, and I think we get sustained economic recovery.
Well, we appreciate your outlook. Fritz Meyer is a senior market strategist with Invesco Aim. Many thanks.